In a span of exactly 48 hours, $20 billion vanished into the digital ether. It was not stolen, it was not embezzled, it simply evaporated, triggering a catastrophic shockwave that erased over $100 billion in shareholder value across global markets. There was no warning. No public filings indicated a systemic risk. The world's most sophisticated financial institutions, Goldman Sachs, Morgan Stanley, Credit Suisse, and Nomura, suddenly found themselves staring into a financial abyss, facing multi-billion-dollar craters in their balance sheets. The epicenter of this financial anomaly was not a sovereign wealth fund, nor was it a massive institutional hedge fund. The trigger was pulled by a single, largely unknown individual managing his own money from a quiet office in Manhattan. He had no external clients, he gave no interviews, yet he secretly amassed a position so heavily leveraged that his personal portfolio rivaled the GDP of small nations. When the dust settled, Wall Street realized it had just witnessed the largest single-firm trading collapse in modern financial history. How does one borrow tens of billions of dollars from the most risk-averse banks on Earth without anyone noticing the exposure? How did a shadow whale bypass the regulatory immune system of the United States stock market? To understand the pathology of this collapse, we must examine the architect, Sung-Kook Hwang, known to the financial world as Bill Hwang. Hwang was not an outsider. He was financial royalty, a direct protege of Julian Robertson, the legendary founder of Tiger Management. In the hedge fund ecosystem, alumni of Robertson's firm are known as Tiger Cubs, an elite lineage of traders renowned for aggressive, high-conviction stock picking. In the early 2000s, Hwang launched Tiger Asia Management. He was exceptionally skilled, growing the fund to over $8 billion at its peak. However, the golden era was interrupted in 2012. The Securities and Exchange Commission charged Tiger Asia with insider trading and manipulating Chinese bank stocks. The firm pleaded guilty, paid $44 million in fines, and Hwang was effectively banned from managing public money. For most, an SEC ban is a terminal career event. For Bill Hwang, it was merely a restructuring. In 2013, he returned, quietly establishing a new entity, Archegos Capital Management. Because Hwang could no longer manage money for outside investors, Archegos was structured as a family office, a private wealth management advisory firm that serves only one client, the founder. This structural classification is critical. In the United States, hedge funds are subjected to rigorous disclosure laws. If a hedge fund acquires more than 5% of a publicly traded company, it must declare it to the SEC. But family offices operate in a regulatory dark pool. Because they manage personal wealth, they are granted vast exemptions from public reporting. Behind this veil of absolute privacy, Hwang began to build. He started with approximately $200 million of his remaining personal capital. He targeted a concentrated portfolio of media and technology companies, Viacom-CBS, Discovery, Baidu, and Tencent Music. The strategy was ferociously successful. Over the next 8 years, Hwang's $200 million grew into a staggering $10 billion. By early 2021, his personal fortune approached $20 billion. Archegos was generating such immense trading volume that the major investment banks, desperate for the massive commission fees, aggressively courted his business. Bill Hwang had become a shadow whale, but his unprecedented growth was not solely the result of brilliant stock picking. It was fueled by an invisible, highly volatile accelerant. The fatal flaw of Archegos Capital Management was a mechanism of extreme synthetic leverage engineered through a financial instrument known as a total return swap. To comprehend the sheer scale of this disaster, we must dissect how a swap operates. Imagine you want the financial benefits of owning a massive luxury hotel, but you do not want your name on the public property deed, and you only have 10% of the purchase price. You approach a major bank. The bank agrees to buy the hotel and put its own name on the deed. In exchange, you enter into a private contract, The bank pays you all the rental income and any increase in the property's value. In return, you pay the bank a fixed administrative fee, and, crucially, you agree to cover any losses if the hotel's value drops. This is a total return swap. You rent the financial performance of an asset without ever legally owning it. Hwang utilized these swaps to a terrifying degree. Instead of buying Viacom CBS stock directly, he went to banks like Credit Suisse and Morgan Stanley. He gave them a small fraction of capital as collateral, and the banks bought the stock on his behalf. This mechanism achieved two disastrous things. First, it provided monumental leverage. For every $1 Hwang possessed, the banks allowed him to borrow $5, sometimes up to $8. A $20 billion portfolio was suddenly exerting the market force of $100 billion. Second, it granted absolute invisibility. Because the banks technically owned the shares, Bill Hwang's name never appeared on the SEC's mandatory ownership filings. But the pathology deepened. Hwang was not just doing this with one bank, he was running the exact same play across multiple prime brokers simultaneously. He went to Goldman Sachs, Nomura, Credit Suisse, Morgan Stanley, and UBS. He entered into massive swap contracts for the exact same handful of companies. Because banks only monitor their own internal exposure, none of these institutions knew the others were extending the exact same leverage to the exact same client. They were operating in silos. Hwang's synthetic buying pressure was so immense that it artificially inflated the price of the stocks he was betting on. As the stock prices rose, the banks credited his account with the paper profits. Hwang immediately used those paper profits as collateral to demand even more leverage, to buy even more swaps, driving the stock prices even higher. It was a perfectly engineered, self-sustaining financial feedback loop. But a portfolio built entirely on synthetic debt is structurally identical to a house of cards. It requires a perpetually perfect environment. All it takes is one slight downward draft, and the leverage reverses its polarity. The terminal event began on Monday, March 22, 2021. Viacom CBS, one of Archegos' largest positions, had seen its stock price surge from $30 to $100 in a matter of months, driven largely by Hwang's invisible buying pressure. Seeking to capitalize on this high valuation, Viacom's management announced a $3 billion secondary stock offering. They were issuing new shares to raise capital. The market rejected the offering. Institutional investors deemed the stock severely overvalued. By Tuesday, Viacom's stock price began to slide. By Wednesday, it plummeted by 9%. This standard market correction acted as a devastating blunt force trauma to Archegos' highly leveraged portfolio. Remember the mechanics of the swap. If the asset drops in value, the client must cover the difference. As Viacom's stock cratered, the prime broker's automated risk systems triggered an alarm. They issued a margin call, a mandatory demand for Hwang to deposit hundreds of millions of dollars in cash immediately to cover the declining value of his collateral. But Hwang's capital was entirely tied up. He had no cash to meet the margin calls. By Thursday, March 25th, the prime brokers realized the severity of the situation. Archegos was defaulting. But as the risk managers at the various banks began looking at the data, a horrifying realization set in. They finally communicated with each other. For the first time, Goldman Sachs, Morgan Stanley, Credit Suisse, and Nomura saw the complete picture. They realized they were all holding tens of billions of dollars of the exact same concentrated stock positions on behalf of a client who was now insolvent. A secret emergency meeting was convened on Thursday evening. The banks attempted to engineer a coordinated, orderly liquidation. They tried to form a pact to sell the assets slowly to avoid crashing the market and destroying their own collateral. But Wall Street is governed by the mathematics of survival. There is no loyalty in a sinking ship. Morgan Stanley and Goldman Sachs understood a cold, clinical truth. The first to sell survives. The last to sell absorbs the total loss. Friday morning, before the market even opened, the pact evaporated. Goldman Sachs executed a ruthless preemptive strike. They initiated massive block trades, dumping nearly $10 billion of Baidu, Tencent Music, and Viacom shares directly into the market. Morgan Stanley followed instantly, unloading their own massive blocks. This unprecedented dumping caused the underlying stocks to freefall. Viacom CBS lost over 50% of its value in a matter of hours. By the time Credit Suisse and Nomura attempted to liquidate their exposure, the market had completely collapsed. The collateral they held was now virtually worthless. The timeline of destruction was absolute. Archegos Capital Management, a $20 billion empire, was vaporized in 2 trading days. While Goldman and Morgan escaped with minimal damage due to their speed, the slower institutions suffered catastrophic internal bleeding. Nomura recorded a loss of $2.9 billion. Credit Suisse, failing completely in its risk management protocols, absorbed a staggering $5.5 billion loss, a blow so severe it terminally destabilized the bank, directly contributing to its eventual collapse and acquisition by UBS 2 years later. The autopsy of Archegos Capital Management reveals a system suffering from severe regulatory myopia and institutional greed. Bill Hwang was eventually arrested and convicted of racketeering conspiracy and market manipulation, but attributing this entire disaster solely to one man ignores the pathology of the environment that enabled him. The true cause of death was the prime brokerage system itself. The world's most elite banks willingly suspended their own risk management protocols, blinded by the millions of dollars in fees Hwang was generating. They handed unlimited financial leverage to an individual operating in total secrecy, effectively providing the matches and gasoline to an arsonist. The Archegos collapse proves that systemic risk does not always come from a global recession or a subprime mortgage crisis. Sometimes the most devastating threats are entirely invisible, incubating in regulatory blind spots, powered by synthetic derivatives that disguise the true scale of the gamble. The markets never forget, but they do forgive the next fraud. Subscribe to Financial Autopsy to see who falls next.